And what that means basically is if you were dealing with a tax-exempt organization or a governmental organization that had a grandfathered 401k, or as I said, a tax-exempt organization that has any 401k, they may be running that on the same platform along with their 403b. If they're governmental, they may also be running what's known as a 457b government eligible plan. So the idea of the regulations were to bring these plans, which common thread to all of them is deferral, reducing your salary and deferring funds into a retirement plan, to bring these closer together. There are still distinctions of rules, but the closer we are able to bring them together, the easier it would be for an employer who might even run 3 of these programs on the same platform to administer these in compliance with the law.
Would you discuss highlights of the regulations and what they mean for employers who sponsor 403b plans?
Bernice, it would be my pleasure. First and foremost among the highlights in regard to these regulations, that the regulations are going to require that a 403b program be maintained pursuant to a written defined contribution plan which both in form and operation satisfy all of the requirements of 403b and contain all the terms and conditions for eligibility, limitations, and benefits under the plan. Now, what I mean by this in regard to a written plan is very, very simple. Right now, 403bs have no requirement under the Internal Revenue Code that they be maintained pursuant to a written plan. The first issue then, as we morph to requiring a written plan, is does this plan have to be a single plan document? And the answer is no. A written plan can be the function of a number of items clipped together, what we like to say by a large paper clip or a large staple. Don't get your finger caught though. But what we are talking about is, for example, a salary reduction agreement, an annuity contract, administrative rules, all put together would be fine. Some folks may already have these in place to constitute that written plan, with the caveat that not only do all those documents clipped together have to satisfy the requirements of 403b, but have to outline what I was talking about in regard to individuals' eligibility, dollar limitations, and how they receive benefits under that plan. The plan concept for the first time is extremely, extremely important. In areas of 403b, individuals have the opportunity, for example, to take plan loans and to take distributions in some instances on account of financial hardship. What's important to note is that for the very first time, as we require a written plan as part of the 403b equation, the ability, for example, to take a loan is not only going to have to be provided for in the plan document itself, as would the opportunity to receive funds on account of financial hardship, but in addition to that, the plan will have to spell out the methodology and the terms under which those loans are taken, the methodology that an individual would have to do to receive a financial hardship. So this is very, very important because all of the participants' rights and obligations and the sponsor's actions will be governed by a single plan. And as I said, that plan could be a compilation of things. If an organization wished to put in a single written document, that's absolutely okay. But again, it has to be a plan, and what you can do as part of that plan equation is spelled out under the plan. Now, to make life simpler, we have also come out with a sample plan revenue procedure. And believe it or not, I think there's enough language in that revenue procedure to be able to write a simple 403b plan.
Does having a written plan cause a non-ERISA 403B to become subject to ERISA?
Bernice, that's an excellent question, and I'm glad you asked it because that has been one of the issues that has dogged us for a very long time with the final regulations moving from proposed to final. We have to begin in answering that question of whether or not merely having a written plan causes a non-ERISA program to become ERISA with the very simple premise that if you are government, if you're government educational and you sponsor a 403B on that basis, you will never be ERISA no matter what you do. Governments are exempt from ERISA. So understand that if you are governmental, that is not an issue. However, if you're a tax-exempt organization, those as I described in 501c3, we have to realize that many of them were not ERISA because they followed a very, very simple safe harbor as outlined by the Department of Labor. The Department of Labor, we work with them very, very closely on this regulatory package, and they basically have told us that the mere compliance with the regulations, which includes a written plan requirement, will not in and of itself cause a plan to become subject to the rules of ERISA, that is, of course, the Employee Retirement Income Security Act of 1974. Anyone who is concerned, should they be potentially subject to ERISA, may want to refer to www.dol.gov/EBSA for guidance directly from the Department of Labor on this issue.
That should be helpful for those concerned about ERISA.
Thank you. Moving on with the regulation highlights, one of the things I'd like to mention is very, very interesting because this is still going to exist on a parallel track now that the regulations are with us. And that is to say that prior to the regulations, we had no requirement under the Internal Revenue Code that these programs had to be maintained pursuant to a written plan that both in form and operation satisfies the requirements of 403B. However, there were form requirements for 403B, not found in any plan which didn't have to exist, but actually found in the underlying funding media for the program. We know that 403B primarily can only be funded by annuities issued by insurance companies and by custodial accounts which are considered the stock of a regulated investment company. Really what we call 403B1 investments and 403B7 investments. So the form requirements that existed quite a bit of time prior to the regulations becoming final dealt with three types of items that had to be included in the very funding of media itself, in the very contract or custodial account, to permit that contract or custodial account to be one that could even be used with 403B. Let's focus for a moment on the annuities. In the annuities, the three requirements were first, that the annuity be non-transferable as outlined in Section 401G of the Internal Revenue Code, that the annuity contained language assuring that on the employer level, elective deferral dollar limitations were not exceeded, Section 401A30 of the Internal Revenue Code, and finally, that annuity provided in individuals who are taking distributions with the opportunity to have a direct rollover under Section 401A31 of the Internal Revenue Code. Under the regulations, really two more requirements, that is, these form requirements, are going to be added to the annuities or custodial accounts. And for the custodial accounts, in the three prior requirements that I was talking about, custodial accounts only had two of those requirements. First, they had to have language under 401A30 assuring that elective dollar limitations were not exceeded. And they also had to have that language I spoke about under 401A31 for direct rollovers. Custodial accounts were not required to have non-transferable language under 401G, since 401G does not really apply to them.